I almost made a massive mistake this morning. I woke up, saw Bitcoin at $90,000, and my thumb hovered right over the buy button. I felt that FOMO, right? That panic that the train was leaving without me. But then I looked at one specific institutional metric and I froze. I didn't buy. In fact, I did the exact opposite. Here is why you need to be extremely careful with this breakout. So look, we are sitting at $89,900 right now. On the surface, it looks beautiful. Green candles, momentum. Everyone on Twitter is screaming about 100K. But here is the thing. There is a dark side to this rally that nobody is talking about today. Reporting from the Saturday session open here in Australia, we are seeing a specific type of liquidity trap that usually forms right before a 15% flush. You know, it is the kind of setup that ruins portfolios because it looks so right until the exact second it goes wrong. Now, let's look at the elite wave structure because this is what stopped me cold. We are in a confirmed bearish impulse pattern, waves 1 through 5. This is not a corrective structure, guys. This is a motive wave to the downside. The last time I saw a 5-wave impulse this clear was back in late 2021, literally days before the market collapsed. It is giving me anxiety just looking at it. The chart is trying to tell us that this push to 90,000 is likely a wave 2 retracement, which is technically a relief rally, not a reversal, right? A relief rally is designed to suck in late longs before the wave 3 crash, which is typically the most violent part of the cycle. I want you to really look at this. If this is a wave 2 top, buying here is literally the worst financial decision you could make this month. You are providing exit liquidity for whales who are dumping into the strength. And I'll be honest with you, it is hard to sit on your hands when prices are moving up. It feels wrong. My gut says buy, but my data says run. And in this game, if you listen to your gut over your data, you go broke. That is just the reality. We have to separate our emotions from the math. Speaking of math, let's talk about the Alpha Flow Pro signal. This tool tracks institutional order flow, not retail noise. And guess what it says? Bear rally. The status is bear rally, and the action signal is caution. It is not saying moon, it is saying watch out. The confidence level on this rally is only 35%. Think about what that actually means for a second. It means the smart money, the guys moving hundreds of millions of dollars, are not participating in this move. They are letting retail traders push the price up with leverage while they sit on the sidelines, or worse, set limit sell orders into the pump. Here's the thing that worries me most about that low confidence score. When price goes up, but institutional confidence stays low, it creates what we call a hollow rally. There is no foundation. It's like building a skyscraper on sand. The moment the retail buying pressure dries up, there is no institutional bid support underneath to catch the price. That is how you get those flash crashes where we drop $5,000 in 10 minutes. We've seen it happen a dozen times before, right? So when Alpha Flow screams caution, I listen. I don't try to be a hero. I don't try to catch the exact top. I just protect my capital. Because if this is a trap, the door is about to slam shut, and I do not want to be the one stuck inside when it happens. So look, now that we understand the institutional setup, let's get into the hard numbers. The metrics breakdown today is terrifying if you are a leveraged long. We are banging our heads against massive resistance at $91,000. We have tested this level 3 times now. Rejection, rejection, rejection. It is like a concrete ceiling. And the more times we fail to break it, the stronger the bears get. They are defending this line with everything they have. On the downside, our support is all the way down at $84,000. Do you see the problem here? That is a $6,000 or $7,000 air pocket. If we lose the local support at $87,000, there is literally nothing stopping a free fall back to $84,000. It is a vacuum. Price moves fast through vacuums. And here's the crazy part about the risk management on this trade. The risk to reward ratio is currently 0.17 to 1. You are risking $1 to make 17 cents. I mean, come on, who takes that bet? Professional traders definitely do not. That is a loser's game, you know what I mean? You want to be taking trades where you risk one to make three, not the other way around. So even if you are bullish, even if you think we are going to 100K, buying right here, right now is mathematically a bad trade. You are buying the absolute top of the range with a mile of downside risk below you. It just doesn't make sense. Now let's talk about the signal box, because this is where a lot of you are getting confused. I see the comments, but Candace, the signal box is green. It says high breakout potential. I know. I see it too. But wait, hear me out. You have to understand context. A breakout signal inside a macro bearish impulse often indicates a B wave trap. It is a fake breakout. It is designed to look like a reversal. It triggers all the bods, it triggers the breakout traders, and then it slam reverses. I have a rule. I never trust a breakout signal when the alpha flow is in bear rally mode. The two signals are fighting each other, and when signals fight, the bears usually win. Sentiment is another huge red flag today. The score is 72 out of 100. Strong, bullish. The crowd is greedy again, and this is happening while we are still technically in a downtrend on the weekly time frame. Think about the psychology of that. People are getting greedy before the trend has actually flipped. That is dangerous. Historically, when sentiment crosses 70 while price is below the 200-week moving average, it is almost always a local top. It means the market is getting ahead of itself. We are pricing in a recovery that hasn't actually happened yet. I'll tell you a quick story. Back in April, we saw this exact same setup. Sentiment hit 75, everyone was calling for new all-time highs, and the funding rates went positive. I got caught up in it. I bought a breakout trade, ignored my risk management, and within 48 hours, I was stopped out with a massive loss. It hurt. I felt stupid, but I learned a valuable lesson. When the crowd is euphoric, you have to be paranoid. Right now, looking at this chart, my paranoia levels are off the charts. I am looking for reasons to sell, not reasons to buy. Now, I want to talk about value for a second, because the power law is showing something interesting. We are currently in the undervalued zone. We are trading at a 9.8% discount to the 16-year fair value model. So yes, Bitcoin is technically cheap relative to its history, but here is the thing that gets people wrecked. Cheap does not mean bottom. In the 2022 bear market, we spent months trading at a 30% discount to the power law. We went from cheap to incredibly cheap. A 10% discount is nice for long-term accumulation, sure. If you are holding for 5 years, buy some here. But for a trader looking at the next 30 days, this discount is not a safety net. It can get a lot wider before it closes. Do not mistake a value zone for a support floor. They are not the same thing. So where does that leave us? Let's look at the price predictions because we need a plan. For the next 3 days, I am laser focused on $91,000. This is the line in the sand. If we see a 4-hour candle close above 91,000 with volume, then and only then will I admit I was wrong. That would invalidate the bearish impulse and open the door to 95,000. But if we get a violent rejection here, if we see a long wick up and a red close, that is the trigger. I expect a swift move down to test $87,000 within 72 hours. On a 7-day view, the scenario gets darker. If 87,000 fails to hold, which I think is likely given the weak institutional volume, we are going to visit that air pocket we talked about. The target becomes $84,000 fast. That is where the next major liquidity pool is sitting. The market loves to hunt liquidity, and right now, the bulls have put all their stop losses right below 87,000. It's like a magnet pulling price down. Looking out 30 days, unless we get a massive shift in macro conditions, like a surprise rate cut or a new sovereign buyer, the path of least resistance remains lower. We're swimming upstream. The trend is down, the momentum is bearish, and the sentiment is too hot. Why fight gravity? I'm personally positioning for a flush. I have my bids set way lower, in the low 80s. I'm keeping my powder dry. I am not chasing green candles into resistance. So here's my final verdict. I am officially leaning bearish on this setup. I think this $90,000 breakout is a classic bull trap designed to liquidate late longs before the real move down. I'm protecting my capital, staying patient, and letting the market come to me. But look, I could be wrong. Maybe the ETFs surprise us. Maybe the whales are hiding their hand. That is the beauty of this game, right? Nothing is certain. But here is the $1,000,000 question for you guys today, and I really want to know your take on this. Are we about to blast through $91,000 and squeeze the bears? Or is this the absolute top of the trap before we flush to 84,000? What is your gut telling you? Drop your prediction in the comments below. I'm going to be reading every single one of them tonight and replying to the most detailed analysis. If you want to trade this volatility without staring at charts all day, you need to be using grid bots. My subscribers get 20% off every single trade fee with Pionex.com, the world's best grid trading bots that print money in sideways and bear markets. I personally use them every day to automate my strategy. The link is in the description. Grab that discount today. Risk disclaimer. Trading cryptocurrency is extremely risky. Do not risk capital you cannot afford to lose. This video is not financial advice.